Gold is closing this week strongly, while silver stayed flat. The spot price of gold is likely to close just over the $1,300 ounce mark in fully fiat Federal Reserve notes. The silver spot price is likely to finish around the $14.60 an ounce mark in fiat US dollar terms. The gold-silver ratio has climbed to 89, a more than 26-year high level. Last time gold-silver ratio hit 90 was in early 1993. This week, we're pleased to welcome a new guest to this Bullion podcast. Mr. Luke Gromen of Forest from the Trees visits with us right after these brief messages from our sponsor.
USdBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, USD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. We are committed to being your trusted source for low cost, highest quality investment grade bullion products. Visit USdBullion.com for more information.
Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of USD Bullion. With us this week's a new guest to the show, he's the founder of unique macroeconomic research firm, Forest for the Trees. Mr. Luke Gromen, thank you for taking the time to come on our podcast.
Hi, James. Thanks for having me on. It's great to be here.
Luke, if you wouldn't mind, maybe start with maybe a little bit of your background. Perhaps the listeners maybe haven't seen you on Twitter or on YouTube videos and such. Maybe give them a little bit of background on who you are.
Sure, I'll just do the quick nickel tour. So I started off my career in investment research at an old line Cleveland money management firm called Ralston and Company, and then was one of the original employees of a split off from that called Midwest Research. And we sold that business, became a partner there. We sold that business to First Tennessee Bank out of Memphis in 2001, worked with what was then FTN Midwest Research, which was a regional brokerage firm ranging from research to banking, market making, etc. Left there with a group of about 20 other partners over the course of a weekend in the summer of 2006 to form Cleveland Research Company, and was doing institutional equity sales there, along with a number of other folks. In both my seats, in 2000. Was with Cleveland Research Company from 2006 until early 2014 when I hung out my own shingle as FFTT. And the way that came about was I had, in both my seats at Midwest Research and with Cleveland Research Company, had been the founder and editor of an internal research product there that was called Heard in the Midwest and then Straight from the Source. And it was an aggregation every Friday of data points we were hearing in our research married with top-down and sector macro work I was doing on my own time. And it ended up being an extremely widely read product on Wall Street and very well liked by the firm's customers. And so, we were able to really help a number of customers position very well at Cleveland Research, very well into the 2008 timeframe. Post 08, as the world became more central bank and macro driven, I was spending more of my time in my sales seat focusing on macro and central bank driven product. By 2013, I decided I wanted to do that full time and went to my partners to discuss that. And they said, we'd be happy to have you do that. But my one caveat was that I wanted to have complete creative control to write whatever I wanted to write, because I felt like it was going to be important in terms of how things could develop potentially to really have that artistic freedom, if you will, to say whatever you feel like needs to be said. And from a merchandising or marketing standpoint, they had a hard time figuring out where to position that product, just simply as a result. They're really well known for deep in the weeds fundamental research. They do a tremendous job at that. And so we parted ways amicably in early 2014. I hung on my own shingle as FFTT, Forest for the Trees. And really what we do is aggregate a large amount of information from a bunch of disparate publicly available resources and we try to put it together in a unique manner to identify developing economic bottlenecks, because it's been our experience that that excess returns accrue over time to those sectors positioned to be helped by or hurt from, in some cases, economic bottlenecks.
Yeah. So if you wouldn't mind, maybe we will start today with perhaps your largest macro view of where the world's economy finds itself, and then drill down specifically maybe to the United States. That's where most of our listeners are located, and maybe even a little bit looking out about what's going on with the U.S. dollar in terms of the structural situation and its future.
Yeah, I think the world is at a very, I won't say unique period, but it's unique relative to the past 70 or 80 years, and by that I mean when you go back 20 years, we had an equity bubble, and that burst, and the policy response to the equity bubble was to kick the problem upstairs to the banking system through the housing sector. And then we had a housing bubble, and that bubble burst, and then the policy response was to kick that problem upstairs to the sovereign level. And now we have a global sovereign debt bubble, and these things tend to only happen once every 80 to 100 years. Usually they only happen and then burst once everybody that lived through the last one is dead, because it takes everybody having lived through the last one being dead to make the same mistakes again.
Yeah.
But here we are, and so when you look back to the 2000 the 2000 crisis. It was the new economy, right? It was the internet. It was a new economy. The world was going to change, etc. And yes, that was true, but it on some level, but certainly the valuations more than compensated for that, and they were a little ahead on their timing, etc. Similarly, when you look at the 06 through 08 time frame, the shorts of those eras. Of that era was what was AAA rated and should not have been subprime mortgages, anything related to some of the mortgage originators, guys holding bad paper on their books, etc. And all of that was sort of that bubble was based on this sort of fundamental fraudulent misbelief, I guess, is the best way to put it, that the ratings were correct because the ratings agencies were saying them. Mm-hmm. And so fast forward to today. After we've kicked the problem upstairs for 2 or 3 sequential crises, we find ourselves with a bunch of sovereign paper rated AA, AAA, whatever you want to call it. And the reality is technically it will always be that, because particularly places like the United States and other major Western sovereigns can create the currency to pay the sovereign debt. It cannot be kept AAA rated on a real basis. And so that's where we find ourselves. And within that, there are different, if you break the world down to creditors and debtors based on how the system has worked since 1971 under the dollar-centric system, which is oversimplified. We run deficits and we send our jobs and factories overseas. And, a number of different creditor nations take those jobs, take those factories, make stuff for us, sell it back to us. We give them dollars, and then they basically vendor finance us with our own dollars. And so we create dollars, they create stuff, and you have sort of this virtuous cycle that has lasted since, call it 71, with some crises that have been kicked upstairs sequentially. But the problem with this system has always been, the BIS, the IMF have always known that you would get to a point where the amount of money that the debtor in the system, that we have to be the debtor because we have to issue debt to issue the dollars to lubricate global trade, the debtor in the system would become so indebted that the creditors would begin to doubt the ability to repay in anything resembling real terms. Mm-hmm. And they would begin to pull back from that virtuous cycle. In other words, they would start to not vendor finance the U.S. anymore. They would start to not buy treasuries anymore. And we hit that moment in 3Q14 when global central bank FX reserves, treasury pile, stopped growing for the first time in 70 years. Mm-hmm. And that has then touched off a series of other things we can talk about. But basically, we've been in this increasing, what was a virtuous cycle has turned into a vicious cycle. and that vicious cycle has been spinning faster and faster since 2014. Depending on whether you're a creditor or you're a debtor or you're an emerging market or you're a developing market or a developed market, there are different outcomes. But I think this is the framework that we're looking at the world, and I think it's the most important framework to use in terms of understanding where we are and where we're likely to be, or the potential range of outcomes where we could be in coming months and years.
Yeah, I believe it was in 2016. I stumbled upon your name through an online presentation that Grant Williams produced called Get It, Got It, Good. And I'll make sure to embed that in the show notes so people can watch that presentation. It was really good, especially when he went into depth explaining the petrodollar, its founding, how it came about, and some of the wheels that perhaps are falling off of that at the moment. I wanted to get your thoughts. I know that you spend a lot of time looking at China, and specifically China and its oil trade, the yuan, et cetera. I wanted to get your thoughts on what specifically is going on there, maybe what's gone on in the past many years, and just give the listeners a view as to what you're seeing.
Yeah, absolutely. So I think when you look at what's going on with China and oil and the yuan, relative to that, my last answer in terms of this new framework, I think in the aftermath of, I think prior to 2008, the entire world was still operating on the post-Volcker, Paul Volcker playbook for the U.S. that he laid out in 1979 to 81, which was, we will put the United States economy into severe distress in order to preserve the real value of the dollar in oil terms, which he did by raising rates to very high rates. And he basically made the dollar as good as gold for oil. He put the U.S. into 2 severe recessions to do that, but he bought the dollar 25 to 30 years of very high levels of credibility. Mm-hmm. Set the table for the 25, 30 years that followed. And I think up until 2008, the world had no reason to think that wouldn't happen again, particularly since, in the Latin American crisis, the Russian crisis, the Southeast Asian crisis, the IMF had always come in and, basically implemented reforms that were very painful. And so when 2008 hit and the U.S. was the center of the crisis, and instead of the U.S. or the IMF enforcing the same types of reforms on the U.S. that they'd always enforced on everybody else, the U.S. said, you know what, we're the U.S. and we're exceptional, and to some extent that's true, but ultimately we're just going to print the money instead. And that was a big wake-up moment for, I think, China in particular, but I think the world at large, because at that moment, that became a matter of a direct threat to Chinese national security through the oil link. And here's why. So at that moment, once we basically declared that in future crises, the U.S. would print whatever we need to print, the problem is that oil is still largely, but then entirely, only priced in dollars globally. And so it's not hard to reach a conclusion that if the United States owes $100 trillion or more in entitlements to its baby boomers, and we're going to print whatever we owe, we're not going to reform, then when we print the $100 trillion plus for our entitlements over a course of a couple of decades or a few decades, the price of oil in dollars for everybody else in the world is going to go through the roof. Mm-hmm. And we saw this dynamic just a little bit in 2008 to 2010 with QE, right? There was no inflation in the U.S. when we printed 3 or 4 trillion, but there was tremendous amounts of inflation in the Middle East. It touched off the Arab Spring. You had very high rates of food inflation in China. Basically, all of our creditors that were absorbing those dollars were seeing high rates of inflation. And that was just with 3 or 4 trillion in printing. We're talking about 100 trillion in printing. Mm-hmm. And the problem is, as Kyle Bass has laid out a number of times, most recently on Hedge Eye publicly 2 months ago, once oil prices get too high and the Chinese are always buying more because they're growing, oil can put them into a current account deficit. And once that happens, they're likely to have a current account, a balance of payments crisis, similar to what you saw in Indonesia, Southeast Asia in the late 90s. You would see a crash in the yuan, you'd see a collapse in Chinese living standards, and you'd likely see social unrest or outright revolution in China. And so this was just simply a non-starter for the Chinese. And so once you realize, okay, if oil prices skyrocket, we're going to have social unrest, best case. And B, we know now the Americans, push come to shove, will print $100 trillion in entitlements. then it becomes a matter of national security for China to get away from a model where oil is only priced in dollars. And you can see shortly after 2008, they began doing so, making moves, whether it was if you're short oil like China, there's really two ways to resolve this. You can you can, number one, start exchanging your dollar reserves for oil supplies all over the world, fields, companies, refiners, etc. And you can, a cursory look on Google, Google China buys oil and just read and read and read and read. They've been doing it for 10 years. So that's one way you do it. And some of those, they even have borrowed the dollars, right? So they're shorting dollars to buy oil. But the problem is even then, you still have exposures over time, et cetera. The second way you can get around this is you work with your oil suppliers to pay in a better currency. And people ask, well, what's a better currency than the dollar to pay in oil? And the answer is, for China, yuan, one they can print. So if they can print yuan for oil, then suddenly the current account deficit, currency crisis case, the Kyle Bass and others have laid out, really becomes impossible. And so you can see steps China began trying to set out an oil contract 5 or 6 years ago. The planning came in fits and starts. The problem, of course, in all of this is that I doubt even Vladimir Putin would take yuan over dollars. And so you have to offer some sort of settlement mechanism for the yuan that is attractive. And that is where we think they have brought these yuan gold contracts in, which is, you may not want yuan, but if China will offer to pay you in yuan for your oil and then allow you to settle those yuan in either Chinese goods or any surpluses left over in physical gold in Shanghai, Hong Kong, or Dubai, then that's something you might consider. And so that was what China worked to set up. In 2014, they opened up the Shanghai Gold Exchange International Board, which really opened this quote-unquote gold window for the first time. Right around then, you saw Russia begin to sell oil in Chinese yuan. In summer of 15, you saw Hong Kong link up with that SGEI exchange. In early 17, you had a Dubai yuan gold contract launch. And then in early 2018, you had the Shanghai or the yuan oil contract open in Shanghai. It was expected to be a flop. It was not a flop. Volumes on the front month at least are as competing with Brent in terms of front month volumes now a year into it. And so that is really, when you look at what China has done with gold, it's really about the yuan, and it's really about oil. And that is to say, what China's doing with gold is attempting to gain the ability to print yuan for oil to avoid what is otherwise an inevitable yuan currency crisis. If they can price oil in yuan, they won't have a yuan currency crisis.
Yeah. I think the latest chart I saw was the yuan, as far as oil trading, is up to roughly 13% on that front contract. Is that correct?
Yeah, I think that's about right. That was, that's around the numbers I've seen. Yeah,
that's a lot. I mean, 13% of global oil trades within a few years. It's a pretty quick move. From 0 to 13. That's pretty impressive.
It's impressive. Yeah, the Wall Street Journal said it took the Brent contract 20 years to reach that level. The Chinese did it in 6 months.
Wow. So when we're looking backwards, we talked a little bit about, some of the things that most people probably didn't see coming, right? The 2008 financial crisis, the QEs, the zero interest rate policies, the negative interest rate policies. I mean, now we have over $10 trillion in bonds, in negative interest rates, right? So yep. We got record global, we have record global debt levels in nominal terms. And we got massive promises that in the West, we probably can't afford to pay at these current currency valuations. I mean, I know that you've talked a lot about the situation the United States was in the 1940s as far as debt to GDP. I wonder what the similarities are currently to that, and are we just simply looking at the easiest way out, which is simply debase the currency?
Yeah, I think the most relevant two comparisons to where we are now are the 1942 to 1951. Era, and really you can even stretch that in, up to about 1960 or 65, And then the other period is the early 20s to early 30s in the immediate aftermath of World War I. And I'll take them each on their own. So in the 1941, late 41, U.S. economy was slowing down, yields were falling, the world was at war, the United States was not in it yet, and it seemed like a really easy trade, right? The world's slowing down again. We're 12 years into deflation. You buy treasuries, and then the Japanese bomb Pearl Harbor. The 10-year treasury yield goes from 2% to 2.5% virtually overnight. And at that, shortly after that moment, the Fed says we will buy every 10-year treasury that the Treasury issues at 2.5%, no questions asked. And it's unclear how many they bought. I don't know that number off the top of my head. But you can see the data. The 10-year never went above 2.5 for 9 years. Now, over those 9 years, and they did this because they needed to finance the war effort. And so basically, you put the United States economy at a tremendously negative real rate, and in a very inflationary environment that was partially offset, at least during the war years, with rationing of real goods. Mm-hmm. Even with that rationing, we've done an analysis of it. From 1942 to 51, while rates were capped like that, the S&P rose. The S&P rose 5x, CPI rose 4x. And treasuries clipped a 2.5% per year coupon. So you can see basically treasury holders never lost any money at all. In fact, they might have made a little money on the initial move down to below 2.5%. But on a real basis, relative to their cost of living, they lost about 80%, 75% of their purchasing power, and lost about 80 or 85% of it relative to the S&P 500. And you can see the data if you look at it from just what were the actual negative real rates, particularly in the aftermath of World War II. In the Western nations, those ranged from negative 5% to as much as negative 60% in some of the worst affected nations. And those negative real rates were held for the better part of a decade, from call it 45 to 55 up to almost 60. And so basically, again, bonds were basically written down to zero. The debt of the war debts were written down to basically zero via financial repression. Mm-hmm. So that was the last time we had global sovereign debt, particularly among Western nations, this high. The other example was after World War I. You had a nation with big inflation-adjusting war reparations who had been deindustrialized as a result of the Treaty of Versailles, and that, of course, is Germany. They had lost the war. There was immense political strife domestically, and so the analog is not perfect vis-a-vis the U.S. Because I don't think our political strife, while less than optimal, is nowhere near what it was in Germany after World War I. Mm-hmm. And we've lost a war, arguably, in terms of the opportunity cost of what we have wasted over the last 15 years with what we've spent in the Middle East, but clearly an order of magnitude or more or less than what Germany went through post World War I. But we too have deindustrialized, except not by Treaty of Versailles, by free trade, quote unquote. Yeah. And we've also have a massive inflation-adjusting war reparation, quote unquote, coming in the form of entitlements. And so when you look at post World War I, the U.S. looks a lot more like a Germany or like a France or like a UK than it does the United States, who was the creditor to all of those nations and was intact by and large, and who was the factory of the world, and who had the gold and the men and the oil, and that was the United States then. It looks, the credit of the world looks more like China now, but again, they're short oil, we weren't, so it's not a perfect analog. The punchline, however you want to look at it, is this, though. There were 6 major industrial nations, U.S., UK, Germany, France, Japan, and Russia, in the aftermath of World War I, and the real value of the sovereign debt of those 6 in a 12-year span fell from 65 to 100%. So again, it was the same outcome. Basically, if you held bonds, the real value of your bonds got destroyed in basically half a generation. And so when you take the step back and say, okay, these are the two most, the best analogs for where we are now in terms of a global sovereign debt bubble and some of the entitlements that are inflation adjusting and look like you keep coming to the same conclusion, which is I get why people want to own bonds and why they're concerned about deflation for the moment. But history is crystal clear on this. It is the real value of those bonds has to be destroyed over the next 5 to 10 years, or else we're all going to have a lot bigger problems.
Okay. I was going to ask about this. I'm sure you've been noticing it a lot. There's been a lot of discussion, and it's gotten louder in the last year or so about modern monetary theory gaining steam. There's also been recent hints that the Fed may begin targeting longer duration bond yields, which is something I don't know if they've ever done before. And even ideas that perhaps they could buy equities outright in the next, if there's another major financial crisis. What kind of curveballs are you expecting or monitoring that could possibly occur in the coming decade, 2020s?
Yeah, I think that the curve targeting is exactly what they did during World War II. Okay. We described before, and it's interesting when I describe some of these dynamics. People say, "Oh, the U.S. could never have a currency crisis, or the U.S. can never default because it or a balance of payments crisis because it can print its own dollars." And I say exactly. And I think there's a lot of misunderstanding about this, about what a U.S. dollar balance of payments crisis would look like. And to me, if we were heading towards one, the very first thing I would expect to see would be for the Fed to begin talking about targeting longer term yields. Yeah. I'd expect to hear, Washington, who can't agree on what day of the week it is or if the sky's blue, to have remarkable bipartisan unanimity about the attractiveness of modern monetary theory. So, to me, I see some of these things going by, and this kind of speaks to sort of, the how we try to look at things in a unique manner is the data and the math clearly suggests this is coming. And when you look at, this stuff historically, rarely internally do nations, do political leaders open up and say, listen, we've really screwed up and this is bad. And so, we're gonna, they're not honest about it, right? It was, Obamacare was the Affordable Care Act. My premiums are up 4x in 5 years. It's not more affordable for me, but, it sounded good. When we invaded Iraq, it was Operation Iraqi Freedom.
It's always the opposite, yeah.
It's I got to get a job with this the naming. I mean, they've got like Madison Avenue working overtime on this stuff. So
George Orwell's got good job security.
Seriously, right? So the people that brought us Operation Iraqi Freedom and the Affordable Care Act are now bringing us modern monetary theory, yeah. which sounds great, and they're excited about it. And look, I try not to, and I think by and large do a pretty good job of not moralizing on it, right? I don't make the rules. I was not alive when, FDR and LBJ, their administrations set up these entitlements. They're due now. And our choices are don't pay them or pay them. Mm-hmm. And, after 2008, unfortunately, the real political cost of 2008 was it made it impossible to reform entitlements. You can't pull 08 and do what you did there. Most specific, you had to bail out the banks. You had to keep the system whole. I get it. But somebody had to sort of get thrown in the volcano. Somebody had to be indicted. Somebody had to go to jail. Somebody had to lose their net worth. And it's interesting, 10 years later now you hear Warren Buffett saying, bank execs should lose their net worth if that happens.
Right. Mr. Bailout King, yeah.
Yeah, right. and so the issue with how that was handled politically was that it made it impossible to reform entitlements, which really needed to happen, sometime over the last decade or 2 decades. And so, if the choice is not pay them or print it, and not pay them is no longer an option, then it's print it. And if it's print it, you know what? There was this great line from the BOJ governor yesterday. It said, "We are buying bonds, but we are not financing the government. We're targeting a price level." And it's like my lawn is wet and there are clouds, but it's not raining.
Yeah.
it's and at the end, like I said about the not moralizing, at the end of the day, for me, the key takeaway is markets and the dollar and currencies aren't going to make a distinction. They're going to see right through this ruse. And so to me, the modern monetary theory, the curve, it's the data is all saying the curveball is going to be the amount of devaluation of currencies, generally speaking, over the next 2 to 5 years is, I think, going to surprise people on the upside. I think it will look, I think, it depends how it's handled, but some of this could be really good, right? I mean, if the dollar falls sharply, that's going to touch off a huge economic boom globally, both domestically and abroad. I mean, we saw a glimpse of that in 2018, right? We came into 2018 and the catchphrase was global coordinated growth amongst a lot of Wall Street strategists. And of course, that faded pretty quickly as we moved through 2018 and the dollar strengthened. Well, it turns out global coordinated growth was really just US dollar down 12% in 2017. And so, the people often seem to forget that the dollar shortage out there, there's a second side to that coin. Yes, everybody's short dollars. But that also means if everybody's short dollars and the dollar falls 30 or 40%, everybody's real standard of living, real demand levels globally are going to skyrocket. And everybody wins, except if you're, long dollars and too long dollars and too long bonds in dollar denominated terms.
Mm-hmm. Mm-hmm. So in terms of, I know that you've talked a little bit about gold, and the future potential for gold. I wanted to get your thoughts a little bit about gold bullion and, just how effective the price management scheme that has been going on this past decade, or this decade really. How do you see potentially gold bullion shaking off its derivative price controls in, the decades to come?
Yeah, I think I think whether or not gold shakes off its derivative price controls, and I think it's a great way of phrasing it, because ultimately when you have a cash settled futures contract along with a highly levered and unlimited leverage, unallocated bullion market like you have in London, you what you do is you shift the price discovery function from supply demand to whoever has the biggest balance sheet. And if it's like the old, it's a version of the old saw that if you don't know you have the biggest balance sheet, you don't have the biggest balance sheet. Yeah. I assure you don't. If you don't have a printing press, you don't have the biggest balance sheet. So to me, the key, the way that gets shaken off is really a function of how the monetary system and the geopolitical world develops, right? Yeah. And so by that I mean I think it goes back to, I think a lot of these creditor nations, China, Russia, Europe, it is a matter of national security for them to move away from purely dollar pricing of commodities, because when we print that $100 trillion for our entitlements, we will hyperinflate their commodity bills, and that will be a problem for them. And so they are clearly motivated to move towards some sort of neutral settlement asset for their commodity imports, and in particular oil. I'll just say oil because it's easier and it's the biggest one anyway. And so I think a key to the success of breaking those derivative shackles will be the success of the yuan oil contract, the success of Nord Stream 2 in Europe, the success of the Iranians in being able to continue to sell oil to people in currencies that are not the US dollar. Because as that happens, you're going to be setting up this de-dollarized trade where you're basically, all of those nations are trying to move the world back to the pre-71 world, which was goods for goods trading with surpluses settled in a neutral reserve asset, or back then it was gold at a fixed price. I don't think gold is going to be fixed in price anymore, but you're really talking about them moving towards the Bancor system that Keynes proposed at Bretton Woods, but was overruled by the U.S. on. And so if they're successful, it's only a matter of time until the derivative market for gold, or the gold throws off the derivative market shackles, if you will, as you put it, because gold's going to need to be made big enough to settle global trade, and in particular commodity oil trade, or it will de facto. I mean, there's oil, Russia's got more oil value in the ground than there's gold in the vaults. And if we want to sell the Russians all the gold at 1250, you know what? Maybe Washington does, but I don't think it's a very good idea. I think we should probably, raise the offers. And I had a tweet to that the other day, right? As we're getting into this heated trade war with China, Bloomberg had an article noting that, China's going on a gold buying spree. And yet somehow as they're doing this, the Anglo-Americans are lowering the offering side on gold to the Chinese.
Right. Yeah.
Why?
And that's been going on. Yeah, it's been going on really since 08 or 09. If you watch physical gold flows, I mean, China came in after the financial crisis, pretty hard, and they've been buying gold pretty heavily in the physical form.
Yes, and that's exactly right. And if you understand what's been going on, you just sort of smile and shake your head and go, now who lowers the offer side to a big buyer, especially a big buyer you're mad at? And the answer is the bullion banks do.
Right. The one with the biggest balance sheets. Yep.
They're the ones with the biggest balance sheet. That's right. Yeah. So to me, the key is if the world moves. And to be clear, this isn't me rooting for China and Russia to win. This is me rooting for an economic system that will be good for. Really good for America, really good for the world, really good for pretty much everybody except a pretty narrow set of interests, around Washington.
Right. Yeah, I mean, whenever I look at the chart, when you compare commodities versus S&P 500, we're sitting at some of the lowest levels, and we've been sitting at them for years now. So people who produce real things, not just in the United States but even around the world, been getting hammered as far as what they get for what they produce. So I don't expect that will continue. I expect a reversion to happen in the 2020s, and I think a lot of what we discussed is possibly how that goes about. But I wanted to give you a chance and let the listeners know, Luke, I really do appreciate you coming on the show. Could you give them just an idea of like what, in terms of when you look out the next few years, what are the asset classes that you like in terms of, I mean, obviously gold is one thing that you're interested in. What other places are you looking at you think are safe to be, or possibly could perform well in the coming years?
Yeah, I personally am overweight gold.
Mm-hmm.
I prefer physical form held out of the banking system.
Mm-hmm.
I own a little bit of Bitcoin. I began buying that recently. Again, I owned some from 2013 to call it mid last year, and was out for a bit and have begun dipping my toe back in those waters. But in terms of more mainstream asset classes, I think it of course depends on your time horizon, because I think in the very near term, I completely understand the mechanical side of dollar strength and deflationary impulses that are going on at the moment. But I don't expect them to last for very long at all. I think later this year, at the very latest, early 2020, the Fed's going to need to be growing their balance sheet again at a pretty notable clip. And I think in that world, and I think that will be basically a permanent feature of markets going forward. It won't be, is the Fed going to QE or not? It'll be, how much is the Fed QEing this month?
Yeah.
And and that's not to be flipped. That's just as you look at the math, again, unless 75 million baby boomers disappear or the U.S. Defense Department goes from, $1 trillion to $100 billion overnight in terms of budget, it's just it's just sixth grade math.
Yeah.
And so, in that world, I want to be overweight, equities broadly. I think, I want to, the value growth, when you talk about, gold relative to financial assets being at near 100-year lows, it's the same type of, spread of value assets relative to growth assets. There's just absolutely no value being placed on real things almost anywhere in the world at the moment, which is really epic, because you're at this moment in time where there is clearly the potential for epic change in the global currency system. We are clearly very close to the United States needing to basically monetize debt for possibly going forward forever in varying amounts depending on the deficits we run. To me, it just seems like a really unique setup, and so I like the markets. I think increasingly, and this is going to sound somewhat flip, but the markets I think increasingly, or security analysis is increasingly going to be something that everything you needed to know about it you learned in the sandbox in your kindergarten, which is to say a Mickey Mantle card is worth more than a Chris Bando card, right? And you're a Cleveland guy, so you probably may remember Chris Bando.
Yeah,
No,
that guy's
Chris
stunk.
Bando, if you're listening, no offense, you're not Mickey Mantle. I love you anyway. And what I mean by that is, equities are finite. Corporate bonds, high grade corporate bonds are finite. Gold, once the derivative market is broken, is finite.
Yeah.
Bitcoin, depending how the derivative market builds up, is finite. Treasury bonds are not going to be finite. Dollars are not going to be finite. Sovereign debt, this global sovereign debt bubble, again, it's been 80 to 100 years since we've lived through this, and people just, it is inconceivable to people at this point that they're going to print this money, but they're going to print the money.
Mm-hmm. Right. I mean, anything real terms, like you're talking arable land, well-located real estate, things like that should preserve value. Anything in the real world that maybe right now is not highly overvalued.
Yeah, I think that's the case. I mean, within any of those, you always still got to do some due diligence on the asset classes and understand your supply demand dynamics, right? So there's a 350, there's 350, $3 million plus houses right now for sale in Scottsdale, Arizona. I saw in the Journal the other day, and they're just sitting. And there'll be buyers for those at some point, but it's going to take the baby boomers that own them dying off and giving the money to their kids, and then the kids are going to go, gosh, look at this $3 million house for $2 million, done, right?
Yeah.
But ultimately, I think attractive pieces of real stuff that's not too highly levered, because you don't want to be wrong for the right reason. In other words, if it's so highly levered and you get the timing off by a year or two, that restricts the leverage restricts your ability to eventually be right, as opposed to having to be both right in direction and timing.
Yeah, correct. So don't get levered in any of those things. I get it. All right. Well, Luke, how can listeners find you and follow your work?
Absolutely. So you can. I'm on Twitter quite a bit, at Luke Gromen. You can go to our website, FFTT-LLC, Frank Tom -LLC. We've got a couple different product offerings there, something we've been getting a lot of great feedback from individuals and RIAs, is our Tree Rings product, which is every Friday we put out a 10 most interesting things list with a quick synopsis of what's grabbed us that week, and a lot of charts, some quick synopsis, and it's $8 a month. To just join that subscription, people have been really raving about it in terms of the value for the price. So I'd encourage the listeners to check that out if they like what they heard today.
Will do. I'll backlink it in the show notes. And thank you, Luke, so much, not only for coming on, but just for engaging so much on Twitter with so many different people. You've been to me, it's been exciting watching your work and to listen to what you think. I mean, your insights are always, I find, interesting. So thank you so much again for coming on.
Absolutely. Thanks for having me on. It was great to be here.